I'm going to start the presentation off with the latest developments and trends. The major changes, the major influences that are going on right now, and really from last quarter and the beginning of Q2 here, is first, we have the majority of the higher risk age groups in the US have been vaccinated. And that's a big deal because if you think about the high risk group, that's the 65 years and older, the majority of that group, I think it's over 80% at this point, have been vaccinated. And that comes into the next bullet point here, which is the US hospitalizations of older age groups have fallen significantly, and so too has the mortality. So very good news then for that area, and we're looking at that trend improving as we continue on. In Q1, we've had very strong economic growth, and it does seem to be continuing through Q2 as we're moving into it. Inflation, people talk about inflation, but the inflation is increasing near term. However, it is expected to moderate longer term. So no real fears, and we'll talk a little bit more about inflation throughout this presentation. And Fed policy continues to signal low interest as well. And again, we'll bring out some more data on that. Another interesting fact out there is the company stock buyback programs is in full swing in Q2. What does that mean? It means that companies are feeling very bullish about the market, so much so that they're willing to buy back their stock, basically let it grow within them to have it for a rainy day. So that's a very positive trend moving forward. Now, current markets and the economy. The 2021 returns. Now, this chart here really shows two separate time frames. On the left-hand side, you've got April's returns, and on the right-hand side, you've got year-to-date returns. And as you can see in April, U.S. equities were really pushing forward and leading the way. And then you had international equities and emerging markets. But when you look at the bond part of the portfolios in April, it actually had a bit of a comeback from what you could see year to date. The year to date numbers for US bonds, international, and emerging market are still negative. However, we're seeing a trend up in April. So hopefully that's going to continue on here in May. But the interesting thing when you look at the equities really pushing forward year to date, especially the U.S. equities up 11.8%, that is largely due to the fact that the bonds have been retracing. If you can't get a good enough return in bonds, people are going to go for additional risk, and that's another thing driving the equities market. Now, let's take a look at sector returns versus globally balanced portfolios. And in this case, we're looking at a 60% global equities against a 40% bond portfolio. And again, we've got this slide broken up into two time frames. April on the left and year to date is on the right. April, again, was a very, very strong month where if you were really diversified in a global equity portfolio with bonds, you were up about 3.2%. If you look at strictly global equities, they were up 4.4 and global bonds 1.3. Now, what was really pushing high in April is the US REITs and commodities. And you can see in April, bonds kind of held its own with the 60-40 portfolio. Now, let's go over again to the year-to-date side. You can see that the global blend of 60-40 is up 4.3, and the global equities kind of moved up even higher, 9.3 year-to-date. But you can also see the bonds globally have dropped. They're down 3.3% year-to-date. And then again, U.S. equities and commodities, or U.S. REITs and commodities, are really the leaders. And you could kind of understand that when you look back last year, U.S. REITs, real estate as a whole, commodities, they were having a really tough time a year ago. So you can see how it's kind of bouncing back. The interesting thing, people would say, you know what, should I be getting into gold? Should I get a lot of gold? Our answer to that is, how much volatility do you like? When you look at the gold prices, it's down about 7.1% year to date. I don't know. I would rather be in a global portfolio and have a little bit of gold in there and be up 4.3. It just stabilizes when you have more diversification in the portfolio. And that's kind of a theme we'll be talking about through this presentation. I love this chart because what it does is it kind of reflects on the markets a year after this major downturn we had back in February, March of last year. So the way this chart works is, in the dark blue, you've got the drawdown of the 4 different sectors here. So from January 1st to March 23rd, when we had the major drawdown occur, if you look at U.S. equities and international and emerging markets, they were all down in the low 30s for that drawdown. And you could see U.S. small cap was down a bit more than that at 40%. Now, let's fast forward through the recovery from March of 24, 20 to March 21st, 21. And you can see that each one of these areas have really bounced back tremendously. It's like they hit the bottom and they didn't want to look back. So the one that stands out the most, however, really is your U.S. small cap stocks. Even though it was down more than the others, it was up considerably higher than the other 3 sectors. The light blue bar at the top that has the percents and the circles in it with the percentage, that really is the total return for each one of those sectors. And again, you can see U.S. small caps really boomed. And it's interesting because you really can't just bounce around from one sector to another trying to chase returns. What I find interesting is the U.S. large cap has really done well for the last few years. U.S. small cap, on the other hand, had a couple slow years relative to U.S. large, but look how much it came back. So if you would have pulled out of U.S. small caps and gone into large, you really would have missed a huge uptick within your portfolio. So diversification, again, is the key, and really stay in the course. The strong recovery that has been pushing along is continuing. This chart here really talks about high-frequency economic indicators. Now, what's a high-frequency economic indicator? It is things that are used literally on a daily basis. So you think about credit and debit card spending, that's done daily. Mobility, in other words, moving around, that's daily. Restaurant reservations, same thing. And what we found really over the last 2 months is we've had a surge back up again, and we believe it's going to continue to move that direction. So things are, again, looking well in the U.S. from a recovery standpoint based on the pre-pandemic. Now, let's go a little bit more globally. Let's go across the pond here. The virus troubles, when you look at the U.S. versus Europe, well, there's a little bit of a dichotomy going on here. Initially, when we had the pandemic, you saw both of the 2 areas drop dramatically, and bounce back. But what you are finding now is there is a resurgence in Europe. They're closing back up again, and there's a couple of things that are happening. One is they are struggling with getting everybody vaccinated. And also, or in conjunction to that, there's a lot of shutdown restrictions, which is really impacting the economic growth in the Eurozone. But in the U.S., different story. if you think about the U.S., you've got some states like Michigan that are still pretty much closed up, but you've got other states, South Dakota, North Dakota, Florida, that are really opening up, and they're kind of offsetting states like Michigan that are still closed down. So all in all, the U.S. is moving forward nicely, and we're expecting it to continue throughout this year. Now, what about inflation? You hear about inflation, is inflation really coming, and how fast is it going to get here? Well, I think many of you know that the way the Fed kind of measures inflation is they have a basket of goods, like bread and gas and, things that you use on a daily basis. And they put it in the basket and they look at the cost of that on a month-to-month basis. And what the Fed would like to do is maintain about a 2% target for inflation. And in this graph, you can see the aqua line, the Fed's 2% target, and you can see the black line, which effectively shows how it's been up and down over the years. Now, the one thing I'd like to point out is when you look at 2020, the inflation actually dropped down to about 0.5%, so 0.5%. And people talk about, well, inflation is coming, and we're seeing a lot of it right now, but in February, we were still only at 1.6%. So even though it was a 1.1% increase, we're still well below the Fed's 2% target rate. And if you look at that dotted line at 2021, and you look at the purple required 3-year average, that 2.4% represents how high the interest rates would have to go over the 3-year average to bring us back to the 2% mark. So inflation right now is not really a problem. And there is kind of, I guess we've all now heard of the K recovery. There's kind of a K recovery going on with inflation too. If you think about it, with the different types of goods out there, you think about construction. Do you think inflation is in construction right now? Big time, yeah, really big time. But when you go to other things like travel, the cost of travel is less right now. Rentals are down. Vacation stuff is down. So we've got kind of a K recovery going on with the inflation rates as well. And that's what's keeping it so low. Some areas are high, some areas are low. It'll balance itself out as the Fed works its strategy. Now, speaking of inflation, how does unemployment play into inflation? Well, if you think about it, employment or wages is one of the big drivers in inflation, right? And it's difficult for people who are either unemployed or are thankful that they're employed to be asking for raises, regardless of whether they feel they deserve it or not. They know that it's kind of a precarious environment out there. So the wages aren't moving up a whole lot right now. And part of that reason is because the unemployment rate is so high still. When you look at this chart, it runs from the beginning of last year to February of this year. And you can see in the beginning of last year, unemployment was just phenomenal. If you were in the restaurant industry, which in my prior life, I worked in the restaurant industry, I really didn't like it when unemployment got that low because it was very difficult to get good help. Well, you fast forward to the pandemic and the unemployment rate jumped up to 14.8. Well, that's a huge spike. And obviously it's because we shut down the country. As time went on and as the vaccine was being produced and the states were opening back up, you could see unemployment was coming down pretty fast, pretty sharply. And then right around the election, it's kind of stabilized a little bit. So we haven't made a whole lot of progress since then. Part of the problem is you've got a resurgence in the virus in some areas. Others is that states just haven't opened up to allow the employment to take place. And then the third aspect, which is a huge one, if you've talked to a business owner, they are so frustrated trying to get help right now because, well, we're paying people more to stay home than they are to work. So at some point, the government has got to figure this out and allow people to go back to work to get this economy back to full steam again. But they'll do it. They'll figure it out. Sometimes they're just a little slow. But, when you think about inflation, I wouldn't really worry about it right now. Will it come down the road? Who knows? It could be 5-6 years down the road before we see anything. But as of right now, it's looking pretty good. So that said, I am going to bring Rocky on. And any thoughts on those charts?
Yeah, that actually looks like both of us on.
Oh, yeah, well, yeah, both are.
I think that two things that came to my mind going through those charts, because everything looked like it bounced back so fast.
Yeah.
Again, it's due to the fiscal stimulus.
That's a big part.
The government pumped a lot of money into the system. And then the other side is what's not talked about a lot is the Fed buying program, where they actually went in and bought bonds.
Yeah.
And they started to prop up the bond fixed income side of the economy by underwriting those bonds so those companies wouldn't default. And that's why you see that huge spike in small companies, because traditionally, the big companies sometimes can ride through a recession, but the small companies get hurt really bad. But when the government came in and started giving the loans to small businesses, they started buying the bonds of companies that said, hey, those companies aren't probably going to go out of business. They might ride through this, and thus the stock values maintained and came back pretty quick. So when we talk about inflation moving forward, one of the things you have to remember is the Fed doesn't have to necessarily raise interest rates right away. What they're going to do first is unwind the buying program.
Yeah.
They're going to start easing off of that and selling bonds back into the open market. So that's something that you've got to watch before you actually see them start raising interest rates. But that's all signs that the economy has got a good foothold. And they believe it's moving forward.
Good point.
So just kind of a couple points on that before we move on.